Nigeria's currency, the naira, has been experiencing a significant collapse driven by a combination of structural weaknesses in the economy and external factors. One of the primary causes of this depreciation is the country's overdependence on oil exports. As oil accounts for over 90% of Nigeria's foreign exchange earnings, any fluctuation in global oil prices directly impacts the value of the naira. When oil prices are high, foreign reserves increase, providing stability to the naira. However, recent years have seen volatile oil prices, and with reduced earnings, Nigeria's central bank struggles to maintain the naira's value. Another reason for the naira's collapse is the widening gap between Nigeria's official exchange rate and the black market rate.
Firstly, thank you for watching, and don't forget to smash that like, subscribe, and notification bell for more global finance uncovered, as we continue to work hard and around the clock to always deliver and improve on our content for you. We would greatly appreciate your additional support by you clicking the like button, notification bell, and subscribe button and joining our channel's growth.
The central bank has attempted to control the value of the naira by setting an official rate. However, due to the shortage of foreign exchange reserves, businesses and individuals have been forced to turn to the black market, where the currency trades at a much lower rate. This dual exchange rate system has undermined confidence in the naira, further driving its devaluation. The foreign exchange shortages are also tied to declining foreign investments in the country. Political instability, insecurity, and a challenging business environment have made Nigeria less attractive to foreign investors. Without a steady inflow of foreign capital, the central bank has fewer dollars to support the naira, exacerbating the currency's collapse. This has been particularly pronounced since the COVID-19 pandemic, which further strained global investment flows. Inflation has also played a significant role in the weakening of the naira. With inflation rates consistently in double digits, the purchasing power of the naira has been eroded. Inflation is driven by several factors, including supply chain disruptions, rising fuel prices, and food shortages, which are often linked to insecurity in key agricultural regions. As prices rise domestically, the pressure on the currency grows, contributing to its decline. Government borrowing and debt management practices have added to the naira's woes. Nigeria's debt levels have been rising, with a substantial portion of this debt denominated in foreign currencies. As the naira weakens, the cost of servicing this debt increases, placing additional strain on the economy. This vicious cycle of borrowing, currency depreciation, and increased debt service payments has further weakened confidence in the naira. The Central Bank of Nigeria (CBN) has responded to the currency crisis with various interventions, such as restricting access to foreign exchange for certain imports and implementing tighter capital controls. However, these measures have often backfired, leading to shortages of essential goods and further increasing demand for dollars in the black market. The central bank's interventions have been criticized for being too reactive rather than addressing the structural issues in the economy. Nigeria's trade imbalance is another contributing factor. The country imports far more than it exports, excluding oil. With a limited capacity to produce many goods domestically, Nigeria relies heavily on imports for food, machinery, and other essential products. This puts immense pressure on the naira as the demand for foreign exchange far exceeds the supply. The lack of diversification in the economy exacerbates this problem as the country remains overly reliant on oil exports to earn foreign currency. Political instability and insecurity, particularly in the northern regions, have also had a detrimental effect on the naira. Ongoing conflicts, kidnappings, and terrorist activities have disrupted economic activities, especially in agriculture, which is a critical sector for both domestic consumption and exports. The resulting food shortages drive up inflation, while the overall uncertainty discourages foreign investment, further weakening the naira. Remittances, which have historically been a major source of foreign exchange for Nigeria, have also declined in recent years. The global economic downturn, partly triggered by the pandemic, has reduced the amount of money Nigerians abroad send back home. This decline in remittances has reduced one of the crucial inflows of foreign exchange that could otherwise support the naira. The lack of significant reforms to address these economic challenges has contributed to the prolonged decline of the naira. While there have been discussions about diversifying the economy, boosting local production, and improving the business environment, progress has been slow. Without meaningful reforms, the structural problems plaguing the economy will continue to undermine the naira, making its collapse more prolonged and difficult to reverse. Nigeria's currency collapse can also be linked to policy inconsistency and a lack of coordinated fiscal and monetary strategies. Over the years, the government has implemented several conflicting policies that have confused investors and businesses alike. For example, there have been sudden changes in interest rates, foreign exchange policies, and trade tariffs. These inconsistencies have led to uncertainty, driving away foreign capital and compounding the economic challenges facing the naira. Without a stable and predictable policy framework, both local and foreign investors remain hesitant, further worsening the naira's fall.
Additionally, corruption and inefficiency in governance have exacerbated Nigeria's currency troubles. Public funds meant for economic development are often mismanaged or siphoned off, leaving critical sectors underfunded. The lack of proper infrastructure, such as energy, transport, and education, limits Nigeria's ability to compete globally, which in turn reduces its export earnings. This failure to build a robust economic foundation makes the naira more vulnerable to external shocks and prevents the country from diversifying its revenue streams beyond oil. Nigeria's weak industrial base is another critical factor in the naira's collapse. Unlike some other emerging markets, Nigeria has not developed a strong manufacturing sector capable of producing goods for both domestic consumption and export. This has left the country overly dependent on imports for even basic goods, which creates a constant demand for foreign currency. The inability to produce competitively priced goods domestically means that Nigeria continues to drain its foreign reserves and imports, placing more pressure on the naira. The informal economy, which makes up a large portion of Nigeria's economic activity, also contributes to the currency's instability. Since many transactions in the informal sector are not regulated or captured by official statistics, they bypass the formal banking system. This limits the ability of the government and the central bank to effectively manage monetary policy and foreign exchange flows. With much of the economy operating outside the formal structures, it becomes harder to stabilize the naira and control inflation. Furthermore, Nigeria's large population and high unemployment rate create additional economic pressure. With millions of Nigerians unemployed or underemployed, domestic demand for goods remains high, while production levels are insufficient to meet this demand. This mismatch forces the country to rely on imports, which in turn drives up the demand for foreign exchange. The high levels of unemployment also reduce household incomes, further weakening the purchasing power of the naira as inflation rises. Currency speculation has also played a part in the naira's downfall. As the currency weakens, businesses and individuals often rush to convert their naira into more stable foreign currencies, such as the US dollar or the euro. This speculative behavior, driven by fear of further devaluation, increases the demand for foreign exchange and puts additional downward pressure on the naira. In turn, this creates a self-fulfilling prophecy, where fears of devaluation lead to actions that cause further devaluation.
Nigeria's banking system has faced its own set of challenges, which have also impacted the currency's collapse. The banking sector has struggled with issues such as non-performing loans, liquidity problems, and governance failures. These challenges limit the ability of banks to provide credit to businesses, particularly small and medium enterprises (SMEs), which are vital for economic growth. The banking sector's instability undermines confidence in the broader economy and contributes to the naira's continued depreciation. Geopolitical factors, including tensions with neighboring countries and shifting global alliances, have also contributed to the naira's collapse. For instance, disruptions in trade with neighboring countries due to border closures or regional conflicts can limit Nigeria's ability to export non-oil goods, further weakening its foreign exchange position. Additionally, changing global dynamics such as sanctions or reduced foreign aid can limit Nigeria's access to international capital, placing more strain on its currency. Global economic trends, particularly the strength of the US dollar, have had a profound impact on the naira. As the U.S. Federal Reserve has raised interest rates in recent years, global investors have flocked to the dollar as a safe haven. This has driven up the value of the dollar while weakening currencies like the naira. The strong dollar also makes imports more expensive for Nigeria, further increasing inflation and reducing the naira's value. Lastly, climate change and environmental degradation are emerging factors that could further threaten Nigeria's economy and currency stability. As extreme weather events become more frequent, key sectors such as agriculture are likely to suffer. Droughts, floods, and changing weather patterns can disrupt food production, leading to higher prices and greater reliance on imports. Environmental challenges also impact oil production, as climate-related disruptions or oil spills can reduce output, limiting foreign exchange earnings. Without addressing the risks posed by climate change, Nigeria's economic vulnerabilities will likely deepen, putting even more pressure on the naira in the coming years.
Thank you for watching, and don't forget to smash that subscribe, like, and notification bell for more global finance uncovered.